Stop what you are doing, because the data that just dropped from the Silver Institute data that is now getting serious attention from Wall Street, from institutional investors, and from the IMF's own commodity analysts contains a number that should make every single American sit up and pay attention: six consecutive years of silver supply deficits, 6 straight years where the world has consumed more silver than it has produced, and 2026 is shaping up to be the 6th. In January of this year, silver crossed $100 per ounce for the very first time in history, and the question that everyone is asking right now, the question that is being debated in trading rooms, in research reports, and in private investment meetings all across this country is whether that $100 level was the peak or whether it was just the beginning. I am going to answer that question for you today with real data, real numbers, and real analysis. No hype, no guesswork, just the facts that the major institutions are looking at right now. Stay with me because this is one of the most important financial stories of 2026, and most Americans have absolutely no idea what is actually happening. Let me give you the headline numbers first because they are striking. Silver gained more than 140% in 2025 alone. That was silver's best annual performance since 1979. It outperformed gold, outperformed stocks, outperformed virtually every major asset class on the planet. Then on January 29th of this year, silver hit an all-time record high above $100 per ounce, a level that this metal had never, in all of recorded financial history, ever reached before. And then, as markets always do after explosive moves, it pulled back sharply. Silver suffered its biggest single-day crash since the 1980s. It tumbled back toward the $65 to $80 range, and right on cue, the mainstream media declared the silver bull market over. They said the bubble had burst, they said the smart money had already left, but here is what the media missed. Here is what they always miss: the data, the actual supply and demand data. That explains not just why silver made that historic move, but why the structural forces driving it are still 100% in place. And if you understand that data, the picture looks very different from the panicking headlines. So let us talk about the IMF data and the Silver Institute data, because this is the foundation of everything. Right now, as of this week, the Silver Institute has officially confirmed that the silver market is heading into its 6th consecutive annual supply deficit in 2026, 6 years in a row, the projected shortfall. This year is 67 million ounces. To put that in perspective, 67 million ounces is roughly 8% of total annual mine production. Imagine running a business where every single year for 6 years, you spend 8% more than you earn, and you cover the gap by drawing down your savings. At some point, the savings run out, and when they run out, the price mechanism kicks in hard. Now, total global silver supply in 2026 is forecast to reach 1.05 billion ounces, a decade high. Mine production is expected to hit 820 million ounces, up about 1% from last year, so supply is growing. But demand is growing faster, and that gap, that persistent, structural, 6-year gap, is the foundation of the entire silver story. Now, here is something critically important that I want to address directly, because the honest analysis requires it. Not everything in the silver demand picture is pointing straight up. The Silver Institute data shows that solar panel manufacturers, who consumed more than 25% of the entire global annual silver supply, in recent years have been aggressively pursuing what the industry calls thrifting. They have been reducing the amount of silver used per solar cell without sacrificing too much efficiency. As a result, photovoltaic silver demand is actually expected to ease by around 5% this year. Jewelry demand is projected to fall more than 9% to its lowest level since 2020, because prices have gotten so high that consumers in price-sensitive markets like India are pulling back. Silverware demand is expected to contract by 17%. Industrial fabrication overall is forecast to decline 2% to a 4-year low of around 650 million ounces. These are real headwinds. Anyone telling you that silver is a one-way, no-risk ticket to easy money is not giving you the complete picture, and I am not going to do that to you. But here is the thing that makes the silver story so compelling, even with those headwinds in place, even with thrifting in solar, even with jewelry demand falling, even with industrial fabrication at a 4-year low, the market is still in deficit, still for the 6th consecutive year, because what is more than offsetting the weaknesses is the surge in investment demand and the growth in new industrial applications. Physical investment demand for silver is forecast to rise 20% in 2026 to 227 million ounces, a 3-year high. After 3 consecutive years of decline in Western physical investment, buyers are coming back. They are buying silver coins, they are buying silver bars, they are buying silver-backed ETFs, and exchange-traded product holdings have already reached an estimated 1.31 billion ounces. Meanwhile, data centers, artificial intelligence technologies, and automotive electronics, areas that are growing rapidly and that have very high silver intensity, are expected to sustain silver consumption across a range of industrial end uses, partially offsetting the decline in solar demand. The London silver market's physical liquidity remains relatively tight. Lease rates in London have climbed to all-time highs as physical tightness intensifies, and a cumulative deficit of almost 820 million ounces has built up across the 5 years from 2021 through 2025. That is the stockpile drawdown I was describing: 820 million ounces of above-ground inventory absorbed by the market over 5 years, gone, not available to buffer future deficits. Right now, before we go any deeper into this, if this data is already telling you something that the mainstream financial media has not been telling you, if you are seeing the silver story in a new way, hit that like button right now and make sure you are subscribed, because what I am about to share next is the part that most analysts are not connecting clearly enough, and it is the part that explains why the $100 level matters so much more than just a psychological milestone. Let us talk about the forecasts, because this is where things get genuinely interesting. The range of silver price projections for 2026 from serious institutions is one of the widest I have ever seen in any commodity market. On the more conservative end, Metals Focus, the London-based precious metals consultancy that the Silver Institute relies on for its official data, expects silver prices to rise to $60 an ounce in 2026. JP Morgan's Gregory Shearer estimated in December that silver could average around $56 to $58 for 2026. Those are the cautious projections. But then look at the other end of the spectrum. Multiple analysts are projecting silver back above $100 before the year is out. The silver price prediction analysis from InvestingCube notes that silver already broke out to fresh all-time highs above $120 in January 2026 before the sharp correction, and projects that by 2030, silver could realistically trade in the $120 to $160 range if current macro trends persist. Goldbroker's analysis notes that in 2025, silver recorded its best performance since 1979, outperforming gold and most other asset classes, and that the structural forces driving that performance have not fundamentally changed, and physical silver buyers, specifically the solar and EV manufacturers who stepped back when silver hit $120, have reportedly returned as aggressive buyers in the $80 range. That is real physical demand providing a real price floor. So why such a huge spread in forecasts? What determines whether we are in the $60 scenario or the 100+ scenario? This is the critical question, and the honest answer is that it comes down to two things. The first is what happens with investment flows. The $60 scenario assumes that the speculative and investment demand that supercharged silver in 2025 does not repeat at the same intensity in 2026, and that is a reasonable assumption for a base case. The 100+ scenario requires that investment demand from institutional investors, from retail buyers, from ETF flows comes back in size, and the data is already showing early signs of that happening, with physical investment projected up 20% and Western retail demand recovering. The second factor, and this is the one that could break either scenario in unpredictable ways, is the macroeconomic and geopolitical environment. The silver market right now is sitting at the intersection of multiple massive forces: the Fed's rate decisions, the US dollar's trajectory, the ongoing Iran conflict and its impact on energy markets, the pace of the AI and EV build-out, US tariff policies and their impact on global trade. Any one of these forces could shift the balance dramatically, and the Silver Institute itself explicitly acknowledged this in its 2026 outlook, noting that ongoing US tariff concerns, strong investment demand, and the persistent fundamental deficit are all providing support, and that the global economic and geopolitical environment is likely to remain supportive for precious metals prices in 2026. Let me spend a moment on the Iran conflict angle, because it is directly relevant and it is creating a lot of confusion right now. When the United States launched Operation Epic Fury in late February, striking Iranian military targets and eliminating Supreme Leader Khamenei, the initial impact on silver was complicated. War in the Middle East creates energy price uncertainty. Energy price uncertainty creates inflation fears. Inflation fears keep the Federal Reserve hawkish, and a hawkish Fed keeping interest rates elevated traditionally pressures precious metals because it raises the opportunity cost of holding non-yielding assets like silver and gold. That is part of why we saw the sharp correction in precious metals after the conflict began. But here is the counter-argument that the bulls are making, and it is a powerful one. If the Iran conflict drags on, if it creates sustained energy market disruption through Hormuz, if it leads to higher and more persistent inflation, then eventually the Fed will face an impossible choice. It can keep rates high and crush the economy into recession, or it can ease policy to support growth and accept higher inflation. Either way, confidence in paper currency takes a hit, and when confidence in paper currency takes a hit, silver and gold benefit. History is very clear on this. The 1,970 oil shocks and the inflation that followed produced one of the greatest silver bull markets in history. The structural parallels to today's environment are more relevant than most people are acknowledging. Now here is something I want you to think about carefully, because it is the thing that separates serious long-term investors from people who always seem to buy high and sell low. The IMF data and the Silver Institute data are not telling a story about what silver will do next week or next month. That is unknowable. Short-term price movements are driven by sentiment, by leverage, by technical factors, by headlines, none of which anyone can reliably predict. What the data is telling us is a structural story about the medium and long-term supply-demand balance, and that structural story has been consistent and clear for 6 years. The world needs more silver than it mines. The gap is growing in some dimensions, moderating in others, but never closing. The industrial applications that consume silver are deeply embedded in the infrastructure of the modern economy: AI, electrification, automotive, medical technology, defense electronics. These are not cyclical fads. They are multi-decade structural trends, and the investment community is slowly but with increasing conviction waking up to the fact that a metal this fundamentally important, this structurally scarce, and this deeply embedded in the technologies of the future was dramatically undervalued for most of the last decade. The gold-to-silver ratio tells part of this story in a very striking way. For most of recorded financial history, that ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has averaged around 15-1. At the peak of the recent silver weakness, the ratio was back above 80-1. Goldbroker analysis notes that the gold-silver ratio has returned to levels last seen in 2013. What that ratio is telling you in the most straightforward terms possible is that even after everything that has happened, even after silver's historic 2025 rally, silver is still historically cheap relative to gold, and that relative undervaluation, combined with the structural supply deficit and the surging investment demand, is why serious analysts are not writing silver off despite the recent volatility. Let me give you the bottom line, because I know you came here for clarity, not just data. Silver hit $100 for the first time in history because the structural forces that drove it there: 6 years of supply deficits, explosive industrial demand from AI and electrification, dollar weakness, geopolitical tension, and a wave of investment demand from buyers who recognize silver's long-term value were and are real. The correction that followed was driven by leveraged speculators exiting, by Iran war-related market disruption, and by the kind of technical liquidation that always follows a massive run-up. That correction did not change the fundamentals. The deficit is still real. The industrial demand is still growing in the areas that matter most. The investment recovery is already underway, and the macroeconomic backdrop, inflation risks, dollar uncertainty, geopolitical stress remains supportive. Whether silver gets back to $100 this year or whether it takes another year or two depends on factors that cannot be predicted with certainty, but the direction of the structural story, the story told by 6 years of consecutive supply deficits and the IMF and Silver Institute data that is now getting serious attention, is not ambiguous. Silver is one of the most important metals of the 21st century economy, and the market is only beginning to price that in. Before I let you go, I want to ask you something directly, because the comment section on videos like this is where the real conversation happens. Are you holding silver right now? Are you watching this volatility from the sidelines wondering whether to get in? Or are you one of the people who bought near the top and are now trying to figure out what to do? Drop your situation in the comments below. I read every single one and I want to know where you are in this story. And if this breakdown gave you clarity that you were not getting from the mainstream financial media, if it helped you understand what the IMF and Silver Institute data is actually saying, do something simple and share this video. Share it with a friend who is trying to figure out what is happening in the silver market. Share it with a family member who is thinking about precious metals for the first time. It takes 5 seconds and it could genuinely matter for decisions they are making right now. Subscribe if you want to stay ahead of where this market goes next, because the silver story is far from over. The next major catalyst, whether it comes from the Fed, from the Iran conflict, from a fresh wave of institutional buying, or from the physical market tightening beyond what the paper price reflects, could come any day. I will be watching, and I will see you in the next one.